And good afternoon, everyone. Welcome to another Wednesday webcast. I'm Pamela Hastings, Relationship Manager here at Barometer Capital. Thank you so much for taking your time on this snowy afternoon in Toronto. Look forward to speaking with you. And joining me today is our Chief Investment Strategist and President, David Burrows. And during this call, we will provide you with a brief market overview. And as well, we're always open to answering questions at the tail end of the conversation. So please email me, phastings@barometercapital.ca, or send me a message via the chat on the Zoom link. Thanks so much. And with that, I turn the conversation over to David Burrows. Good afternoon, David.
Hi, Pam. How are you? It's nice to see you if it's only virtually.
I know.
Nice to see your face.
It's been a long time since we've all seen each other, hasn't it?
It sure is, and I've been fortunate over the last couple of weeks to be having some calls with folks, and certainly the Zoom format is a great format to spend a little bit of time face to face. And just off the hop, if there is somebody who would like to have a call sooner rather than later, I'm just working my way through, and certainly happy to do it. Sadly, we're not meeting in person these days. Thanks everybody for taking the time to join today. A little bit of bumpiness in the market last couple of days, and so some stuff to talk about. Certainly lots of things that are topical. There's been some excitement in the small cap world. I'm sure people have been watching the news, so we'll talk a little bit about that as well. What I'd like to do is just sort of go through the top to bottom as to what we see going on and where we're positioned and what we see coming at us over the next little while. As always, I'll talk through the lenses that we use. We're trying to identify key structural themes to focus our portfolios in. We don't need to be everywhere. And so I think most people know that we believe we've entered sort of a reflationary environment and that will be a tailwind for an extended period of time for certain sectors and themes. A lot of them sectors and themes that people have avoided for the last several years. Certainly sectors and themes that get helped by, this extreme stimulus that's been pushed into the system and liquidity. And certainly, I think for a lot of people requires some repositioning from the things that did well in falling rates. So what we think is market leadership right now is sort of the reflationary theme and the things that go along with that. We do spend a lot of time watching for signs that there is change, either at the asset class level or at the sector level or geographically. We are seeing some shifts over the last while in leadership from sort of a pure US equity focus more to a global focus. And so the portfolios have changed in nature a little bit over the last weeks and months. And we always watch for signs that there is a significant pickup in risk and the way that the market is handling news. I always like to say that the market tells you a lot by the way that it handles news. When you get a scary news headline and the market's able to absorb it, that tells you the market's on a pretty good footing. If you get great news and the market doesn't care, you have to sit up and notice. Maybe, it's in the market already. And ultimately what we're trying to do is have this tactical approach where we pick our spots, manage our exposures, and certainly be prepared to go to the sidelines if that's required. So as always, we'll start out just with the big themes. We continue to believe we're in a structural bull market in stocks in the US. It started in 2013. And that continues. We've been in this channel since we exited really what was a long consolidation in US stocks. Things consolidate two ways, either in price, which certainly it did through 2001 and 2, or 2007, 8, 9. Those are bear markets. In time, when a market has had a long rally like it did through the 80s and 90s, it needs a rest. And people take their money and go other places with it. In the period between 2000 and 2010, really income securities became much more attractive. They were more predictable. And then we exited in 2013, and we've been in this channel really ever since. The NASDAQ, of course, was in a consolidation or bear market from 2000 through 2016, and eventually exited and made new highs, and that was the beginning of a new bull market, and we've been in that channel ever since. certainly with some interruptions along the way. Our view has been that we've been going through a generational bottoming in interest rates. We saw yields on 10-year bonds at 0.5% in March of this past year, and we're here sitting just above 1% right now, and that's certainly probably the beginning of something, not the end. We also have talked about the fact that after being through a significant bear market in commodities, which tend to go hand in hand with what's going on in the global economy, and global stocks, they appear to have been making a turn. We've talked about this turn we've seen in commodity prices over the last number of months, and it's not going to be a straight up move, but the risk reward we think there looks pretty good. So just as a reminder, we're using this process that we have to make our decisions and to try and take individual news items out. We take all of the various investable areas we could focus in, and we try to identify asset classes and sectors and geographic regions where breadth is expanding, where money is being put to work, where more and more securities are participating in a rally, a broadening market. And we'll call those areas market leadership. And then we try to find securities to express our view. And that might be an ETF that represents the whole theme, or it may be single shot securities where we can see in the fundamental characteristics that financially things are good, getting better, where we're seeing acceleration in the underlying business metrics. And then, of course, prices that would support that view, prices that are performing strongly relative to the market and relative to their peers. And then the third piece of the strategy, and this is an important one, it may be important over the next while, we'll have to see. We have a very disciplined selling strategy, and we run ratcheted stop losses. So we enter a position at, say, $10, and let's say our stop loss is at $8. And as a position works out as we hope or expect, we ratchet the stops higher. And that's important because it lets us stay in the winning positions as long as they work. And the reality is, in any given year, if you had 20 positions, 2 or 3 do way better than you expected. 7 or 8 are pretty good and a bunch don't work. So it's all about staying in the ones that work and having a process to take us out of positions when they stop working. So we certainly look to those stops as being an important source of risk measurement. Okay, so we've talked a lot about how much stimulus has been pushed into the system globally. We talked about how many dollars are being printed to try and keep the system liquid during going through this pandemic. So liquidity is really, really important to a bull market. And one of the things that we've always said is don't fight the Fed. So last week, M2 money supply expanded by $370 billion. Year over year, the growth in money supply is over 26%. To put that in context, you can see the order of magnitude here on the chart. So it's kind of like, don't fight City Hall. The Fed is making it clear they want the system to be liquid. The Treasury and the US government are saying we want to have stimulus in the system. We want to make sure that the system is well oiled, and that's not to be discounted. We talked about how the US dollar has entered a weakening period versus other world currencies. People have been using dollars to buy risk assets. Again, it's not going to be a straight down move. Things consolidate, move, consolidate, move, consolidate, move. And so in the last 3-4 weeks, we've seen a little consolidation in that trend. It doesn't change it, but it means maybe some of the things that are helped by a weak dollar or are signaling a weak dollar have been consolidating a little bit, but ultimately we think the target is lower. So there's a shorter term picture of that same instrument, US dollar, DXY, and it has rallied a number of times, had a little rally over the last couple of weeks. All the moving averages are moving lower. We're below the long-term trend. I think that this is more of a consolidation than a change in trend. So what does well with a weak dollar? Well, emerging markets tend to do very well. When the economies globally are strengthening, there's lots of demand for products coming from emerging markets. And so money tends to get put to work. And we know that China is coming out of the virus more quickly than the rest of the world. We know that there is a demand for stuff because people aren't having experiences. So we know that the The trade deficit with Asia is widening. And on a relative basis, emerging markets have been relatively outperforming the S&P over the last number of months. So this is the emerging markets ETF, and it came out of actually a bear market. It's been in for many, many years. But certainly over the last week, it's consolidated back toward these moving averages. At this point, not too much to be concerned about there. The Chinese market, the same thing, over the last 4 weeks has been consolidating, still well above rising moving averages. Taiwan, you look at a long-term chart back to 2000, you don't see anything. If you were to look at a shorter term picture, this is about 2.5 weeks of trading, just trading and consolidating back towards the moving averages. So when we had our breadth thrust at the beginning of December, the comment was we were likely to see corrections that were small, 3 to 7%. And when we looked at the 5 cases where we had seen a breadth thrust in the past, the majority of pullbacks over the next 3 months were 3 to 5%. So I think we're about 4% off the highs right now. We pulled back today. The S&P pulled back 3%, NASDAQ about 3.5%. We're pulling back into these moving averages to cut out some of this overbought. This is the Chinese consumer discretionary stocks back into the moving averages. If you take a look at the S&P, we consolidated in October and November and then took off. And after the election, the market rallied. We've stayed above these moving averages. We're sitting just above, or 1 or 2% above the 50-day moving average. So we're certainly going to watch that. And we're in this channel that we've been in since the beginning of November. If you take a look at the NASDAQ, it's the same picture. Okay, so the NASDAQ is off about 3.8% off the highs, pulling back into the moving averages within the channel. And clearly the earnings coming out of Apple and Amazon, Lam Research tonight are all important things for us to watch. Commodities. Commodities have led since November, consolidating over the last 2.5, 3 weeks while the US dollar is consolidating. And we've seen some stocks like Freeport pull back into the 50-day moving average, okay, just like it did in September. So all of these things are having a little bit of a pullback at this point, not something that we should be overly concerned about. Commodities and emerging markets tend to be highly correlated. They tend to do well when when we're looking out to a stronger economy. And so we think that there is quite a lot of room in these commodities and emerging markets because they're just starting to come out of a very difficult period. Copper is one of the areas we're most interested in. We talk about Freeport-McMoRan. We talked about some of the other major producers like First Quantum. Inventory levels are low at exactly the time when we expect over the next number of months demand to ramp up. Consumer discretionary pulled back a little bit into moving average, continues to lead. Lots of strength in this area. We talked about the autos last week. We've talked a little bit about home builders. The supply of homes in the market in the US and Canada is at decade lows. So we expect as we come out of the pandemic, there is likely to be quite strong demand for new homes and existing homes. And certainly the home improvement space is one that we've continued to focus in as well. Financials are pulling back into the moving averages again. So what we're seeing across these leadership groups is things pulling back. Semiconductors did the same thing. And the clean energy, same thing, pulling back into moving averages. But fundamentally, these groups are very interesting. In the case of solar, the cost of solar components continues to plummet, and it continues to look more and more competitive versus other sources of energy. So the fundamentals for copper are strong. The fundamentals for alternative energy are strong. The fundamentals for consumer discretionary are strong, but we're bound to have some pullbacks along the way. Now, we talked last week about the fact that after many months, the large cap growth stocks re-accelerated, and now we're into the earnings. Netflix led off the earnings, and Alphabet had been strong, and Apple has been strong, and Amazon. We're going to find out. We get Apple right away, and we get Amazon next week. We're going to see how the market handles these earnings. But one thing that's undeniable is the cash flow for these companies continues to grow very steadily. So fundamentally, there's a reason to be there. Now, we're all about finding relative strength, and we would say that the economically sensitive groups are outperforming the bond proxies. Consumer discretionary versus consumer staples. This week, new relative highs. Technology versus consumer staples. Relative strength, new highs. Communications versus consumer staples. Relative strength, new highs. These themes continue to play out. On the gold, while the US dollar has been bouncing a little bit, still consolidating. This is a very long-term chart. We broke out back here in 2012. We rallied and made new highs. Over the last few weeks, we've been consolidating. That's a healthy thing. Now, one of the things we're getting questions about is what's happening in the small cap and mid cap stocks that have been highly shorted. I think this is a story that has been all over the news over the last few days. This is the share price of GameStop. So they sell video games through their stores. Probably a lot like Blockbuster was at one point in the video space. It's a business that is probably doomed ultimately unless they make a major shift. And as a result, it was a company that was heavily shorted. Like 130% of all the shares outstanding were sold short. And one of the things we know is that over the last 6 months, private investors have become very engaged in using the excellent tools that are being provided by the online discount brokers and have become very active in trading. Some call it the gamification of the market. And so through social media and through blogs, small investors are targeting companies that are vulnerable to a short squeeze. So share price starts to rise, you're short the stock, you're encouraged to buy the stock back. The higher it goes, the more painful it gets. And you can see for some folks, it became very painful over the last few days. So just to be clear, for the most part, these are companies with very poor fundamentals. They are not companies that would meet our business tests. You should not expect that we're going to participate in these types of things. It's not to say people can't make money at it. It's not how we make money. And certainly, you know, there were people earlier today that bought the shares at $375 and wound up selling them at $220 or $240 and took big losses. That's pure speculation. But there is a lot of retail money in the market. This is the amount of trading, of total trading that is being done through dark pools meaning off exchange. And a lot of the off exchange trading is being done by the discount brokers. So 48% of all volume. We know that small investors have become highly speculative and are trading a lot of call options as a percent of NYSE volume, exceedingly high relative to history. So we do think that there are some risks in these areas. We do think that there are some risks of blowups. These are things that we are staying away from. We're focusing on what we think are the big structural themes, but it's certainly interesting to watch and certainly interesting to hear about. But this has been probably the biggest short squeeze in market history. This is the 50 most shorted stocks in the market versus the broad market, the Russell 3000. So this has been going on since November. This is a really interesting phenomena. The speculative side of it is probably not matched since the late 1990s, but certainly they're being encouraged to do this because it's been very, very profitable. It's just not our game. So non-profitable tech relative to the NASDAQ is having a spectacular go. This really is not our bailiwick. So just going back to our themes, dividend achievers, the dividend growth theme continues to work and continues to be very attractive, we think, for our income strategy. We think this is the natural destination for investors who are seeking income and are going to need to deal with a rising interest rate. If long-term interest rates rise, you need a rising stream of income, so dividend growth becomes very attractive, and certainly since November, outperforming. At the end of the day, we're going to continue to use our process. We're looking always for areas of the market that are showing expanding breadth, where over time, a higher and higher percentage of stocks participate. And we watch every day for signs that breadth starts to deteriorate. And we do that at the market level, at the asset class level, at the sector level. And we try to reduce our holdings when we see breadth deteriorating within one of the universes that we're focused in. So last week, when I talked about our indicators, I said, our long-term indicators, the percent of stocks in the Canadian market that are in clearly defined uptrends, has been rising and continues to rise. This was as of last week. Same for the US market and same for the global market. I mentioned that globally, the percent of stocks above the 50-day moving average or short-term trend had weakened a little bit, was still holding in very well in Canada. Percent of stocks with weak positive weekly momentum, percent of stocks hitting new highs versus new lows, and percent of stocks trading above their 150-day moving average continued strong. What has changed from week to week? We've seen some stocks in the US market trade down below their 50-day moving average. So that's something that we watch. The other three short-term indicators continue to be positive, and our long-term indicators continue to be positive. So that's something we watch. This is the S&P on the top of the chart. And down here, we're showing the percent of stocks trading above their 50-day. This is something that we watch. On the other hand, the percent of stocks trading above their 200-day or the long-term moving average remains very sound. Now that's important because when over 90% of the companies in the NYSE are trading above the 200, in the S&P 500 trading above the 200-day moving average, a year out, the percentage of times you're up money is 99.2%. So this is something we will watch. Our one short-term indicator has shown some weakness. The other three are sound, and our long-term indicator is sound. So clearly it looks like we're having a little bumpiness in the last couple of days. The US dollar has had a bounce. It's caused some consolidation in some of the underlying securities. We watch for continued change, but at this point, things look decent. We're going to continue to look for expanding breadth. We're going to continue to be cautious of deteriorating breadth. Okay, so key things that market is keying on: COVID cases in the US do appear to be starting to pull back a little bit. We'll see whether that continues. That's a net positive. Market continues to look for higher inflation or reflation that's showing up in the market. We're positioned for that. Spreads on corporate bonds, both investment grade and high yield, continue to narrow, meaning that investors in corporate bonds are feeling more and more comfortable with the credit risk that they take on. And when it comes to earnings, and this is the big one for right now, the historical trend for the fourth quarter is that analysts tend to cut their ratings all the way through the fourth quarter and through into January. This year, estimates rose all the way through the fourth quarter because analysts felt they'd been too pessimistic. They pulled back a little at the end of the year and now are going sharply higher. At the end of the day, we get driven by earnings. Earnings, liquidity, credit, strength. These are things we care about, and we like to see that as time goes by, estimates are getting better. Now, so far, we've seen 115 companies in the S&P report their earnings. Sales growth is up about 0.73 of 1%, and earnings growth about 1%. If we look over the last number of quarters, both sales and earnings got compressed going through COVID and are now starting to recover. The expectation is second quarter and third quarter will get first quarter and second quarter will get a lot better. As it stands, as far as surprises go, of 115 companies reported, revenues are coming in about 3% better than the estimates. So no wonder estimates are going higher into quarter end. And the earnings surprise is 20% better than what had been expected leading into the quarter. So often when the market looks expensive, it's because the analysts are behind the curve. Things are getting better faster than they think. So clearly we're going to watch for the rest of the quarterly reports. We're going through them one by one. There's some important ones tonight, so we'll see what happens. But certainly this is something that we think is a positive. Last couple of things. if you buy stocks relative to bonds, you're doing it because you think you get paid to take risk. Right now, 70% of stocks in the S&P pay a dividend yield greater than the yield in a treasury bond. So if you think the treasury bond yields are going higher, you'd like to have a dividend yield that's higher than a treasury bond and one that grows. Dividends tend to grow over time. So when we look at it in the scheme of things, this is very attractive relative to history. We think this is a great time to buy dividend growth stocks. From a sector perspective, not a lot of change over the course of the week. We reduced our industrials weight a little bit. I think we could see a little bit of a pullback. We reduced our materials weight a little bit. Think we could see a little bit of a pullback. We became a little bit more defensive, just tactically. We think this is a short-term issue. So far, we're having a decent start to the year. All of the pools and funds and separately managed accounts are well ahead of the indices for the quarter. I know it's early, but it's always good to get a good start on things. And we look forward to working our way through the quarter and into the end of the first quarter. If our indicators start to turn negative and get more defensive, we certainly will get defensive. But at this point, we think that there's some very clear early stage themes that we're focused in. We think that they can go on for several years with small interruptions. And certainly it's not going to be without bumps. But in general, we think that the longer term backdrop is constructive, and we'll just continue to update. So with that, Pam, are there any questions?
Dave, we have one question here. I know you touched a little bit on metals and mining, but we have a specific question on Freeport-McMoRan, which is a name that Barometer knows very, very well. So perhaps you could comment on that.
Yeah, so look, Freeport's biggest product is copper. And we talked a little bit earlier about the fact that we are at multi-year lows in copper supply. There are no new mines coming on. And so pricing for copper in general has been quite strong. Remember, we're in a pandemic. And so we're looking forward 6 to 9 months to what prices might be at that point. We did put the chart on the screen, and I'll see if I can do that again, just to make sure everybody saw it. Change what I'm sharing here. Share. Go here. We're going to say Freeport-McMoRan. Okay, so this is the long-term picture of Freeport-McMoRan over the last year. You can see we've stayed above this 50-day moving average all the way along, and we've pulled right back into the 50-day. You can see that we consolidated here through the month of December. So we pulled back into that consolidation level. So this is likely where it sort of finishes its check back, and probably a great entry point for new positions. Most of the metals have pulled back over the last 7 or 8 trading days. Certainly, though, no change in trend.
Thanks so much, Dave. Next question here is a comment on Air Canada. What are your thoughts on where Air Canada goes from here?
Look, the airlines in general are, something that will benefit as we come out of this pandemic. You can see that if we take the whole group of airlines, and this is an ETF that holds airlines, this is the jets. This was the high in February. This is the major sell-off we had going into the pandemic. We've rallied a number of times, and it's been fits and starts. And recently we rallied into the sort of the middle of December, and we've been pulling back since then. This whole group has been one that was targeted by some of the speculators buying the most shorted stocks. It's a group I think we still have to be careful of. It's a group that likely has a good turn. Air Canada certainly is less expensive than its peers, but it's had the similar experience. And so it's probably not one for the faint of heart. And we'll have to see if this group can turn around and get going again.
Thanks so much, Dave. Another question, very Canadian-centric question. Any thoughts on possible changes to the capital gains tax in Canada? There's been rumors about it this spring. I suppose we need to wait and find out if those come to fruition, but would love your thoughts on that.
Look, all of the spending is going to have to get paid for at some point. And whether or not we think that it's a good idea from a long-term strategy perspective. I think that the Liberals are going to be looking for places that they can raise some revenues. So we don't think that it's something that happens in a hurry. If it were to happen, it probably happens in steps, but it would not shock me if the inclusion rate went to 75%. In the US, probably it could happen as well, although I would hope that given the precarious nature of the economy, that if you're trying to fuel growth on one side with fiscal and monetary stimulus, the last thing you want to do is to stifle capital markets on the other side. So my hope is that it's not something that's immediate, but if I had to make a guess, it's more likely to happen in Canada than it is in the US.
Lots of questions today, Dave. We have like 95 people watching, so they're all flooding in. Here's a question. The amount of expected stimulus to slow to come, will that affect our call on the US dollar, do you think?
I think that the stimulus programs are never easy to get past. And I think that we have to expect it's going to take some time. But I think that there is motivation on both sides of the aisle to get something done. So there is going to be some political theater, but at this point, the Fed, which is most important, is making it very clear they're going to keep their pedal on their foot on the gas. And you know, it's remarkable over the last few months on the fiscal stimulus side. You know, it's been a lot like Charlie Brown and Lucy with the football. The football keeps getting yanked away just before something gets done. But the market has shown a real willingness and patience to see something get done.
Thanks so much, Dave. Well, that concludes our questions for today. If anyone has questions that they would like addressed, we're happy to do that offline. I know sometimes I get questions that are singularly focused on a specific stock. And those questions are sometimes best for our analysts to have the opportunity to do a deep dive on in order to give you the best response. So again, you can email me, phastings@barometercapital.ca, and we will address those questions offline. And with that, David, do you have any further comments for this afternoon?
The last thing I'll leave you with is, at the end of the day, I think that one of the reasons that we have clients who are with us is that we do try to be accessible. If you've got questions or things you'd like to talk about, please let us know. The counselors can set up times for a Zoom call and a discussion. Very happy to be doing that. I think it's a great time to be talking. Second thing I'll say is, if we expect them to continue to print money, we're going to need to take cash and have it positioned in productive assets. If we are getting a little pullback here, probably a great time to be adding because we do think that it's going to be a pretty good year. And last thing is, if you've got a question and you don't want to have a conversation, please don't hesitate to send us in a message and we'll try and address it either on a call or directly. So with that, Pam, thank you very much for hosting today.
Of course, it's always my pleasure. I wish that I could see you all in person, but my living room will have to do for now. Thanks, Dave.
Thanks, Pam. Thanks, everyone, for joining us.